Hey everybody, it's Brian Shannon from AlphaTrends.net. Today's Wednesday, the 21st of September. I hope you were paying attention on Twitter. I had pointed out these volume-weighted average price levels just as they were being hit here in the S&P 500. That was pretty much the exact high of the post-Fed rally, right up to the volume-weighted average price from the CPI. We've been talking about that since the day of the CPI, and today it rallied up to that level and then got the shit kicked out of it. The path of least resistance is lower. We know that because we have a declining 5-day moving average, and we don't trust rallies with a declining 5-day moving average. So, the path of least resistance continues to be lower in all of these markets. On the on the weekly time frame, we're below the volume-weighted average price from COVID and about to approach the volume-weighted average price from the pre-COVID high. I'm not really expecting that to be a level of support. The path of least resistance is lower. We'll always get bounces along the way, but until we have the longer term moving averages on those weekly timeframes flattened out and then beginning to rise, then in that would look something like this on the weekly time frame. Then it's going to take some time for that to happen. So there's just no hurry to be involved in this market except for trades when we start to see markets back above flat to rising 5-day moving averages. That's not the condition we have now. Sellers remain in control. It's guilty till proven innocent. We saw a large sell-off here, after the Federal Reserve down, 13, 12 points there. So that's a pretty sizable sell-off. But, maybe we get a rally up tomorrow and then continue lower. What we're going to look for is if these prior levels of support, like the 390, did become resistance. We spoke about that in the weekend video, that support in this area was likely to become resistance. Now we're going to be looking at this area as kind of the same. Now, it doesn't mean it has to just, run up right to that level and then drop for us to consider the next leg lower. A lot of times it might come up through there slightly, trick some people, and then continue lower. I'm also still open-minded that the market could turn around. I don't think it's going to happen. I think it's highly unlikely that the market's going to turn around. But when you get locked into any one belief on either direction, that's when you start to see big losses multiply. And this type of volatility is exactly why I'm a trader. You always want to lighten up in front of a key level, such as a CPI report last week or ahead of the Federal Reserve. When we know there's something coming that's going to produce a lot of volatility, you either want to get out of the way or switch to a very short-term time frame and look for day trades in there. And I'm not going to get into that because this isn't a day trading video. The NASDAQ is in a similar situation. Still, they look like they're probably headed for a test of the June lows. Now, that's an easy call to make, but what's not easy is to say how that's going to happen. It might end up doing something like this and then getting down there. Some people will claim victory and say, see, I told you over there that it would hit here, but they fail to mention all of that move. So, the path of least resistance is lower. We're below a declining 20 and declining 50-day moving average, which is below a declining 20, 30, and 40-week moving average. So again, guilty till proven innocent. We're right down to the volume-weighted average price from the 2018 low, and that hasn't held before. It hasn't really shown significance, so there's no reason to think it will at this point. This in the NASDAQ, we did get up through the CPI volume-weighted average price, but we were, this is why we have multiple VWAPs. The day that that the market made a high this month, that was pretty much the volume-weighted average price from the peak. So when you look at my tweets, you'll see that I always have these on there. The blue is the month to date. The high of the month is right here. I took the black one off because it was just in the way. I had a black one here that was representative of the prior low. Russell 2000 also, right up to the volume-weighted average price from CPI, and it got the shit kicked out of it. And it's in a downtrend, and this is what downtrending markets are supposed to do. They're supposed to make lower highs and lower lows as long as they're below the declining longer-term moving averages. And, if we're going to turn around, you don't have to pick the bottom to make money. You want to be involved in a time where it makes sense. This market is down to the volume-weighted average price, or I'm sorry, it's tested previously the volume-weighted average price from the 2016 low, and perhaps it's heading there before a new low is made. Semiconductors have been the laggard. They continue to be the laggard. Still, they got above the 5-day moving average, but what was the direction of the 5-day moving average in there? No reason to buy when the direction of the 5-day moving average is still declining, especially, and if you're going to buy in that condition, you want to look to the bigger time frame and say, do I want to fight the direction of the 20, the 50, the 100, the 200-day moving average, etc.? Energy names continue to decline. They are below declining 5-day moving average. There's just no reason to own those. I do these video updates every single day for subscribers. At the end of the day, I also do a midday video. And, when the market's this volatile, if you want to stay on top of it, I'd suggest you take a trial. If not, give it a thumbs up or like, whatever you do on YouTube. And thanks for tuning in.